Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Glad that you could join us today. Really looking forward to trying to help you with your, the financial part of your retirement. Whether you're retired already or heading into retirement, a lot of these things will help as far as that goes. So, of course, you can ask questions live. We'd be happy to try to answer them. You can send them in as an email here at talkmoneywithtom.com, or you can, hit the chat box here on the channel and put in your, question there. Also, we'll try to answer those live. We do have this channel. We've had it for quite a while now. We've got a lot of content on the channel. So we believe that there's kind of a lack of, information about what to do financially in retirement. And so you can subscribe to this channel if you'd like to continue your education. You hit the little bell button if you want to get notified when new stuff comes in. And then obviously if you just want to ask Ethan and I questions, personally, you can do that by setting up an appointment. Here, there's a book appointment button, looks just like that. It's up on the corner of our actual website for our business. The link for that website is here on the channel also. Set up a 30-minute time to meet with us, and we can try to help you as far as that goes. So anyway, looking forward to today's show. Lots of stuff is going on right now, that's for sure. I'll start off with kind of a summary for what's happening in the market here. And as we are speaking right now, the market has been coming down. Israel, had a strike against Iran really kind of last night as far as that goes. The market was down, 0.7%. And then we had a retaliation strikes that have been reported now into Israel. The market was down about 1.2%. Is it still in that same neighborhood now, or has it gone?
1.1.
1.1. Okay, so I don't. It's interesting. These conflicts happen. Pretty predictable pattern actually for the most part, which is like for Ukraine. The market dropped pretty heavily when Ukraine was first invaded, and there was some real concern about oil in that one too, because Russia produced 11% of the world's oil and such, and oil did skyrocket up to $130 a barrel. Excuse me. Hello, I'm back. Swallowed something the wrong way. I think that's the first time that's happened. We've done a lot of shows.
Yeah.
It is live, which is I think kind of fun sometimes, but something happens. But so, in terms of these conflicts, oftentimes the market does recover. It'd have to be something that would affect the economy for the market not to recover. And so far, we've seen oil prices go up 7%, which is not insignificant, but so far we haven't seen, oil being heavily involved yet in that conflict, for example. And Iran, actually, most of their oil production goes to China, upwards to 100%, actually. So, it's still important in the overall scheme of, the price of oil, but because inflation is one of the threats. And so having oil go up would be an issue, but
Yeah, but it looks like with the Israeli strikes, there was nothing targeted at oil per se. So,
Right.
the bigger question is, will there be any kind of action into the straits? because that's a big shipping area of a lot of oil and natural gas. If Iran does something, I think there'd be a lot more political or a lot more military.
Yeah, that's where you could really mess with the price of oil theoretically. I think a third of the world's oil and natural gas goes through the Strait of Hormuz, I think it's called.
Yeah, sure.
Um, and so, it's definitely some impact. The market's down because of what's happening today. But at least where it's standing at the moment, again, you got you look at this as a person, you might think one thing. You look at this as the market's going to look at it, which is what I'm trying to train everybody here. It's a little bit different sometimes, These conflicts are deadly, and they're no fun to deal with at all, I'm sure. But the market's probably going to be okay with what's happening so far. There are bigger issues that the market has to deal with, right? So that are more long term, and so that's basically. I'm going to do something a little bit different here with Eason and I are going to kind of brainstorm, what's really, good. What over the next 12 months, what could propel the market forward, and over the next 12 months, what could make it go down, right? Yeah. Because look, we've had this nearly 20% drop. We've recovered almost all of it. Back above 6,000, down below again. I got to take another break. Hang on.
Okay.
All right, try it again. Sorry about that. Um, and so, one of the comments that came in this week from the weekly videos from Adam actually is asking about, are we still out of the market in some, because as I mentioned before, we were at 63%. After Liberation Day, we dropped down to 23%. We back up to 46% now. Exposure to stock market across the board on our average client. So we're still about 25% less stock than we normally have. And the reason is because the way I look at things, and just in a sense of, you're going to take a certain amount of risk. Your risk-free rate right now is pretty high at a little over 4%, right, for T-bills. And so, your market rate of return, at least in the S&P 500 average, is about 11%. And so, you have to look at this teeter-totter. This is the ongoing conversations I have in my head all the time. Is the positive aspects that could influence the market to the upside, are they high enough to stay 100% invested, or even 110% invested, or whatever it might be?
Yeah.
And so, and let's talk about what the positives are. I mean, the market right now expects a rate cut, right? I think it's at 75% in September, rate cut. And so rate cuts are good for the stock market. Some of that's already priced in. And so, but that's a positive. You've got a situation where, this tax bill likely will be considered a positive by the stock market if it does pass.
Yeah,
right?
because people will have tax cuts, and then corporations will also possibly get tax cuts.
Yeah, the theory is that it's just more money that can go into the economy that's not going into the government's coffers, so to speak. We are at this period of time where we have a lot of debt, 36 trillion, and so adding to that debt is going to be harder and harder as we go forward. But I still think over the next 12 months, a tax cut bill, somewhat similar to what we have, probably will be different by the time Senate gets done with it, will actually be seen as a positive, right? Of course, artificial intelligence is huge, right? To me, it's the .com, of our, time frame here. And 95 to 2000 was the best 5 years in the history of the stock market. And, I remember very specifically, we didn't know what the internet was going to be able to do. We had no ideas for, that it would turn out the way it has turned out. But there was a lot of enthusiasm about the possible power from that. And, the stock market went nuts. And really, we had a, incredible PE ratio got to 45 on the S&P 500. Of course, it got ahead of itself. Market fell 48%, before everything was over. But we're not even close to the animal spirits portion of the artificial intelligence wave, in my opinion. So I think it's a very powerful force, and maybe one of the most powerful. Ultimately, it could lead to another big drop like we had in 2000 if it gets too carried away. But
Yeah.
but we're not there. So I think that's probably one of the biggest powerful pieces. We have this the tariffs. There are some positives potential, right? Number one, the courts have said that current tariffs are illegal. They appealed that, got a temporary stay, probably goes to the Supreme Court.
Yeah.
Supreme Court could say these tariffs are illegal, and I think it's one of the things that's really weighing on the market. So if you took off the tariffs, if the courts did that, the markets would move pretty heavily, I think, to the upside. However, it might be mitigated somewhat so by the other ways that they can do tariffs. And so that still might come in. And then there's this concept that Trump always chickens out, right? And honestly, if I didn't think Trump was going to chicken out on these tariffs if he needed to, I probably wouldn't be in the stock market at all. So I think that's a benefit. He put up those Liberation Day tariffs, which were way too high. Market just crumbled. Bond market started falling apart. But he backed off, right?
Yeah.
And so he's shown that capability to back off. I do think one of the things, though, that bothers me, and I'll save that for the negative side, is the fact that he now knows about this taco concept, which might make it less likely that he actually backs off. Because I got to feel like right now that's what the market's looking at. These tariffs, even if they're bad, it doesn't really matter because they'll adjust the tariffs when needed. And if that's true, then that's probably the biggest piece on the negative side is those tariffs. So, Congress could step up also if they needed to. If for some reason the president and or his group doesn't back off on tariffs and is starting to cause all kinds of problems, Congress does have the authority to take back tariffs.
Yeah, and they can place their own tariffs or supersede them, basically.
Exactly right. And so I do feel like, that's a possibility, but it's a very light possibility in the current environment. It would probably take some significant pain, so it really doesn't help. I think I don't count it as much on the positive side. Market might need to be down 40 or 50% before they finally take action. So that doesn't help us much as far as that goes. I will say, I'm a big believer that the market moves in a particular direction because it knows a lot of things that maybe I don't know. And so, a positive moving stock market generally means good things, right, are coming. Now, not always. And really, it's not so much just the current trend that we're on right now. It's more the primary trend that we're on right now, right? And so, at least on my book, the primary trend is still negative. We haven't broken into a new high, and some of these other things that need to happen to say the primary trend is up. Because, again, you can get a lot of false moves. 2022, we had 3 big moves to the upside, even though the market ended up breaking all those moves down. And here we are trying to break through. I think we break through here, but I don't know. I mean, if we don't, I think it's quite dangerous.
Yeah, because that would be a double topping, which is a very scary chart to see.
So I'd still probably put that more on the positive side right now because we're really close. We backed off some today now because of this, Israel-Iran situation. But I still think, there's some momentum there to kind of get through to a new all-time high. I guess the next question will be, is it real? Because we've had a couple of breakthroughs to all-time highs this year. They weren't very high, and then they fell back down pretty quickly.
Yeah, they kind of fizzled out.
Yeah, so, that could happen again here. So I'd like to see some sustained, motion above the all-time high as far as that goes. So those are anything else you can think of on the positive side?
The labor market and inflation. Inflation's kind of, tamed itself in a sense. It's not really going up or down. It's kind
Yeah.
of just maintaining,
Yeah.
which is kind of fine for most people.
Right.
And then the job market's still strong,
Right.
and that's quite positive.
Yeah, I don't put those much weight on those currently, only because
They're going to be lagging.
well, they are lagging indicators, obviously. Especially the labor market, because it takes a while for companies to lay people off if they need to or what have you. But more importantly, we have these impacts that are coming that aren't here yet. And so it kind of skews the data for me. And when I look at, oh, yeah, there's 134,000 jobs created, part of that's because of the tariffs in a way, in this weird, perverse way where people are actually pre-buying things, cars and iPhones and what have you. And we actually have a good economy heading into the impact of tariffs, which we haven't been able to see yet. And of course, we don't even know what those tariffs are going to be. We don't know what the impact's going to be. We don't know how long they're going to last. We don't know if they'll adjust them up or down, right? So that's a hard one. So, okay, on the negative side, I started off with the Federal Reserve, might lower rates. But if they don't lower rates, that's a negative for the stock market because there's already some baked-in expectation based on, what the market is
And
seeing.
it's been pushed back multiple times this
Yeah.
year. The expectation has been pushed back.
That's right. I remember it was quite high for a rate cut in June, remember, at the beginning of the year. And here we are in June, and that's nowhere on the table whatsoever. And now we're talking about September. And again, potentially by the time we get to September, we might see some of the impacts of tariffs. And if those impacts happen to be inflationary, then, we might not see a rate cut then either as far as that goes. So, that's going to be a negative to the market if we don't actually have the rate cuts. Obviously, if we have a rate increase, we've got all kinds of issues going on. But just the thing, the tariffs are the number one thing. And they're the thing that kind of weigh this for me so that extra 25% of stock market exposure is not in the market. Historically, tariffs have been awful for stock markets, have been awful for, especially at this level, right? Little tariffs, not so big, but big tariffs like this have been historically really bad. But it's still very, very difficult to tell what this means because, the last time we had big tariffs like this was 1930. We were a goods economy much more so than we are now.
Yeah,
right?
it's hard to gauge any kind of data from that period.
Oh, yeah. It's like the pandemic, right? When the pandemic hit here in 2020, you want to go back and see, okay, what happened before? How did this work? Useless information, really, right? I mean, in the end, because it was so long ago and things, the government pumped out $10 trillion between quantitative easing and all these stimulus things. And we had one of the best stock markets I can remember, in that, period as we recovered. So I guess I will put that on the positive side. I forgot that piece. That does have to do with Congress. It is quite possible in today's world, every time we've had some type of significant issues, Congress has come up with some way to push money out the door to we did it in 2020, we did it in 2008. So if tariffs cause problems or something breaks, there's no doubt in my mind that Congress would look at the possibility of going out and doing some type of stimulus type of things. I will say it's going to get harder and harder and harder to do that because it's debt. We're taking on more debt. Bond market's already had a couple little freakouts here, sending some warnings across. I think the bond market's happy right at the moment, but you go try to put out another $10 trillion for the next big problem, I think you'd have all kinds of issues.
Yeah,
with
the
that.
bond market already signaled that, it doesn't want to take on any massive
Right.
deficits right now.
So maybe that's there, though. It's still on the positive. And so, if you look at deportations, I put on the negative side because, you're taking taxpayers who are working in jobs, in some cases, out of the system. And so, and they're doing jobs that, in some cases, that other people don't want to do. And they're often doing them probably for cheaper than what you would do for the replacement people that would come in. And so, we'll see. It takes a pretty big number of deportations to make that work, and we'll see how that plays out. But to me, historically, it has been a negative on the economy, at least in the short term.
Yeah, and it doesn't have to be deportation of actual people. It could be the fear of deportation.
Yeah, yeah.
Because any business that has employees that aren't showing up to work,
Yeah.
you can't have a business run that way.
Yeah, exactly. So I put Taco on the negative side and the positive side. So Taco's Trump always chickens out, right? So on the positive side, it's true. I think there's 22 different times where he chickened out just in this particular run of negotiations. It's probably a bad way to say it. Really, it's more like he pivoted or whatever you want to call it.
Yeah.
But now that he knows about Taco and he's all mad about it, he doubled the tariffs on steel and aluminum, started squabbling with China, as far as that goes. So, you know, uh, again, the fact that he pivoted or chickened out was a benefit. If you take that away, I think that's a huge risk to the stock market. If he really sticks with his things, even though things are starting to fall apart pretty heavily, that's a big problem. So it's kind of weird. Uncertainty probably needs to be at the top of this list. I'm hearing this from all over the place. I'm hearing this from different people, within the clientele. You're reading articles about the uncertainty creating situations for CEOs. And so, if everybody starts to think, oh, this is bad, you kind of end up with bad. I mean, it's a self-fulfilling prophecy. So that's definitely happening.
Especially how the U.S. market is based on the consumer. If the consumer is uncertain and stops spending,
Yep.
you're going to have trouble.
Yeah, that's right. And so, of course, the tariffs have pissed people off around the world and scared people, too. So tourism has dropped dramatically. I keep reading about $12 billion less revenue coming in from tourism.
Yeah, and this hurts a lot of just certain states or locations, where tourism is a big part of their economy.
Yeah.
Another thing is just retaliation against U.S. goods. Even if we're exporting it, are they actually being sold or just staying on the shelves?
That's right. Yeah. Yeah, exactly. You're hearing about these situations where people are canceling contracts because it's an American company. Even though it's not a tariffed, product, it's just, we don't want to buy American products. McDonald's has talked about it some in different places that we're seeing that. So, yeah, I put that on the. You cut back on government spending, and that sounds like a great thing, and it probably is over the longer term, but in the shorter term, what you're doing is taking that money out of the economy, right? So you're taking tourism out of the economy, you're taking, deportations, you're taking that tax revenue out of the economy and that spending ability out of the economy. You're doing government layoffs and cutting back on government spending, not doing all of these different grants and different programs. That's all taking money out of the economy, and it does help, potentially lower the deficit in total. Of course, you keep the tax cuts going, it might not, but it would still be lower. But in the short term, that is a economic, negative, right? And I'm looking at the next 12 months. So I guess the other thing I'll put out there, kind of the geopolitical tensions and something failing. So one of those two things happening. So when you start to put things under pressure, you have a higher probability of something failing, like Lehman Brothers failed in 2008. And that's one of the reasons why I would want to have 25% in T-bills of my stock market allocation in T-bills at this point in time, because when something breaks, it'll happen. The market will go down so fast, you'll definitely have a hard time getting out. Whereas if you're already out, maybe you lost out on some, gains that you might have made if things go up. But that's something I worry about. I look at China. And China, we had, I think in May, 35% less exports to the U.S., and their overall exports are still high because they're now starting to go to the rest of the world is coming to them, and they're able to now really flex their muscle on this rare earth metals. We're basically begging for magnets. Wait until they flex their muscle on their 98%, antibiotic, distribution or production. I think they have experience here where the possibility of invading Taiwan starts to go up. I don't know that it'll happen. I hope it never happens. But you just made it more likely with this particular tariff situation, because now China has started to see, hey, this isn't so bad. Dealing with this situation. They have 800 billion of our bonds. I mean, they have set themselves up over the last 40 or 50 years to take over some very critical areas and purchase a whole lot of our bonds. They are ready for warfare, more so than we are. And so that's become a higher issue, right? So I don't think that'll happen. But honestly, usually when something fails, it's not even something we're talking about.
Hmm.
That's what makes it so dramatic. Who could have guessed? I think Lehman was a 108-year-old company at the time. Who would have guessed that they would fold up, right? Bear Stearns would have folded up right before him, but they bailed them out. Another really old company. So, um, that the risk becomes a little higher. So anyway, those are the pieces that we've been looking at as far as that goes, and really just trying to kind of look at that teeter totter and say, okay, here's all these positives. And again, if I was to just name two, I'd say AI versus tariffs. And you throw in all the other pieces that come with those. But can AI be good enough to outdo the issues that tariffs could do? The answer is still, it's why we're 75% in, because the AI is in my opinion is real. It's just starting. We're really just beginning to see the impacts of that, and we're certainly in that overall scheme of a run like we saw in the .com. I'd be surprised if we're even halfway through. Tariffs could disappear, right, or it could be adjusted, and so that's why you make a little bit more bet to the positive side here. As far as that goes, and then just wait and see what's going to happen and see what really does happen with these tariffs, and it'll give you more confidence one way or another. So anyway, that's where it's at. I think it's a really interesting time frame to be an investor. It's a very, very difficult time frame to be managing money, as I've mentioned before, just because of the uncertainty around the tariff situation, right? It makes it almost impossible to determine what might happen. This is not a normal economic event. There's nowhere to go back and look at anything in the past because it's too old. And so you just kind of have, that's why keep a little bit of powder dry and kind of wait for things to play out here and see how it goes. So anyway, that's our summary for the week here. I'm glad everybody was able to join us. We won't actually have a summary next week, just as a notification. I'm going out of town Thursday, Friday, and Monday. So, keep doing the videos and Monday through Wednesday, but then nothing until the next Tuesday. And no show and no summary. Okay, good. Let's start off with our first question.
Does the market have capped upside without a catalyst? For example, it could be tariffs going down, the tax bill coming through.
Yeah. So can the market just keep going and going and going without a catalyst? I think the answer is yes, because I think the catalyst is already there. I think the AI situation is the catalyst, and yeah, you could add to that. Definitely. You take away tariffs, you get the tax bill through, you do some deregulation that the market gets excited about. Nobody's been talking about that for some reason, because it's really not happening. Everybody's distracted with trying to get this bill through, which is fine. Yeah, I think it really can continue to go. It has to, the only way that it continues to go the way it's been going, because we've recovered almost everything from this tariff situation, is that there's some expectation that turns out to be correct, that tariffs aren't a big deal, right? Or they're a minor hit, they're not a big deal. They have been in the past at these levels, and honestly, it seems like these levels might be going up. We've got this pause coming up and all this stuff. So, but it's possible that they're not a big deal for a variety of reasons. But yeah, it's a good question. I think it can continue to go, and I do believe that we will break through to the new all-time high, just because there's not enough known info on the bad side.
Should I have any long-term concerns, or are there opportunities with the Israel and Iran conflict?
Oh. Yeah, as I mentioned in the summary, generally when these conflicts happen, the market does drop right away, and then it comes back. So just on a pure pattern standpoint, you'll get some dip buyers that are going to come in here and buy. We don't have economic impacts that have been identified yet because of that conflict. Price of oil is up 7%. That's an economic impact. It's not insignificant, but we're still at around $72 a barrel. That's not a hugely inflationary, number at this point in time. So, I don't see, because even if it spreads, which it obviously is, they've retaliated now, and you're going to have this kind of back and forth that goes on. it has to have an economic impact. Otherwise, the stock market starts to ignore it. I mean, we still have a pretty serious conflict going on with Ukraine, and we just had 2 years of plus 20% gains in the stock market. So, again, I'm not talking about this from a personal standpoint or what I think about this or the casualties and the disaster that these types of situations cause. I'm just talking about how the market generally looks at these types of conflicts. And probably the opportunity, unfortunately, is, to buy on these dips if that's the only catalyst that's driving it down, which seems to be true today at least. And we're seeing that, actually. We saw, right away when bad news is put out today, it'll drop to 1.2%, and then it kind of inches back up. There's dip buying coming in here, based on this conflict. So, that's kind of the way it is. All right. All right, we're back. So we're getting this out of the way in one show here, huh? I had 2 coughing fits, and then it must be contagious.
Yeah. So the next question is, how do you bridge the gap in income when you retire but haven't started Social Security?
Okay. I guess it's, there's one question I would have: do you actually qualify for Social Security? So are you 62 and older and you just aren't taking it? Because if you are 62 and older, the first thing you want to do is to see when you should be taking it, right? So we would run that in our plan. And again, there's different ways of looking at Social Security. One is kind of a program that just looks at Social Security and looks at the optimal time to take it. The one we prefer is where you're doing it inside your entire financial plan, because when you do take it from someplace, there's going to be some loss of return in that particular area. Does taking Social Security make it better or worse than taking the money out of your assets? So that would be the first place to start if you're already 62 or older and aren't taking Social Security, is just, should you be taking it?
Yeah.
And if not, or you're younger than 62, then you basically look at your assets, and we deal a lot with money going out to support lifestyle, right? I mean, that I would say we specialize in that because we have our average client's 74, and so most people are taking some money out. And so what you want to do, in our opinion, is you set up a systematic withdrawal. You leave 3 to 6 months worth of money in the money market, have everything else kind of invested in your model. Every 3 to 6 months, you go back in and kind of replenish, and you have a certain set dollar amount coming out of that money market every month. And you really want to start, though, on what they call the optimal withdrawal sequence.
Where's the most optimal tax way to take the money?
Yeah, it comes down to lowest return, lowest tax. Okay. That's first, all right, which almost always is like money you have in your checking and savings account or something like that. And so that you start there and start spending that down. Okay, well, there is a level that you probably shouldn't go below, for your own comfort or even just for logistical purposes. But let's say, you have 100,000 there and 50,000 is what you really need. Well, use the first 50,000, to live off of, and then stop and go to the next. So it's, again, lowest return, right? Lowest tax. And so one of the things kind of is a weird area is like the Roth IRAs and the Roth 401ks. And so that can be lowest tax, right? But the net rate of return is probably the highest you can have, right?
Yeah.
And that's why you put it last, because if I make 11% a year in that thing, I don't have to pay any taxes on it, versus I make 11% a year in almost anything else, I'm going to pay either capital gains or ordinary income if it's in an IRA or 401k. So that's at the very end of the list, right? So you look at your sequence of withdrawals should be, lowest return, lowest tax. And you just go through all the assets that you have and holdings and such, and you just kind of continue to do that with a couple caveats. Number one, don't run your cash down to zero, right?
Yeah.
Run it down to the level you feel that you can. And sometimes you need to build it up, so it doesn't matter. You go to the next asset. The other thing you want to be careful of is not taking your portfolio out of whack, because sometimes, like, oh, I got a stock and bond portfolio, my bonds don't have any real gains, so I start selling those. All of a sudden now you have a 100% stock account, right? Which is kind of, skewing your overall situation. And if you have that mixture should be identified as something that's going to work for you over the long term, so you're not panicking in these big downturns. And so if you've sold off yours and messed up your mixture, yeah, that's what we do. First of all, make sure that, if you're over 62, that you shouldn't be taking Social Security already, and if you're not over 62 or shouldn't be taking it, then kind of use this sequence of withdrawals to identify, the best places to get the money from. And your Social Security is growing. I think it grows prior to maximum age about 5.5%, not maximum age, full retirement age, which right now is 67. And then after 67, it actually grows at 8%. So
Yeah, so if you have the assets to bridge the gap,
Right.
it is kind of very nice to have that.
Right.
Because Social Security is very much considered heavily guaranteed income.
Yeah, exactly. And you even get the cost of living increases that they do after full retirement age. So it's 8% plus cost of living increases if you're not taking it. So
And then Social Security also never goes down, too.
right, and that's right. At least we hope it stays that way. So, but yes, that's a good question. All right.
So how does the U.S. dollar falling affect the U.S. stock market and bond market?
Yeah, it's been interesting because the dollar has been coming down. I think it's down, over the last year, kind of in that 7% range, high 6% range. And it did run up a lot after the election. There was some, expectations. Those expectations haven't been met. The tariffs seem to have caused people to, not want to be in the U.S. as much with their assets, whether it's our stock market or our bond market. So it's kind of weird. It's a sort of a chicken and egg thing, right? So if I'm an international investor, a falling dollar, right, it doesn't help me because now I'm converting someday back to my currency and I'm not getting as much. So in other words, if I bought something that didn't move at all and I had euros, let's say, I'm down 7% versus my currency already. So now that whatever I'm purchasing has to make 7%. And so I think that's the biggest issue there is when the dollar's not doing well, you don't get as much foreign capital to come in and buy into our markets. And we have been the place, both from a safe standpoint and from a return standpoint. Up until just this year, the U.S. has dominated.
Yeah.
And now we're seeing better returns coming out of places outside the U.S., Europe and what have you too. Even emerging markets have had a little run here.
Yeah, and so it depends on the company because, like, if a company is really heavily dependent on exporting, then they're going to do well.
Right.
If they're heavily dependent on importing, they're going to have a rough time because it costs more to get the goods to come into the U.S. So
Yeah.
it really depends on the type of business. And so each business could have kind of a spectrum of
Right.
how it's affected.
Right, exactly. Yeah, and then tariffs, the design around tariffs is to reduce the trade deficits with the countries outside the U.S. One of the disadvantages of that is that oftentimes when countries or companies, foreign companies, have sales here in the U.S., sometimes they'll keep it here in U.S. dollars, and they'll purchase our treasuries, which is good for the bond market, right? So, and that's where the dollar falling kind of tells you right now that it's quite possible that again people are moving assets out of the U.S. As a whole, at least for the moment.
Yeah, and so if countries don't have good foreign demand for treasuries, it kind of hurts our interest rates. It forces
that's right.
yields up and all that
Yeah,
kind of stuff.
yeah, which
so.
we've seen. Yields are up instead of down. They were falling before, and now they're still okay, but they're higher than they were.
Yeah, and you can kind of see also how international has outperformed over the short term.
Yep, yep, yep. All right. What's the next question?
What are the downsides of tax loss harvesting?
So tax loss harvesting is where, let's say at the end of the year, you'd go into your portfolio. If you have something at a loss, you'd sell it so you can gather that loss. And so you can use that loss against gains.
Hmm.
And you can use it against future gains. So it's sort of like having money in the bank, and so that way, if I have something in the future that I want to sell that's at a gain, like let's say a lot of people have Apple, right? So there's a lot of questions around Apple right now. And obviously, the tariff situation is really tough, and what's happening, and their manufacturing is mostly in China. They're trying to move it. They don't have Steve Jobs anymore, right, to do all this innovation. But if you have this huge gain in Apple, well, okay. So if you had some losses someplace else and you wanted to pare down your position in Apple, you could take those losses and then offset it with the gain. But there's a couple of disadvantages. Number one, of course, is that if you happen to want to buy that security back, because you really do like it, it's down right now, I just want to capture that loss and put it in my loss bank, so to speak, you have to wait 31 days to avoid what's called a wash rule.
Hmm.
And so, because otherwise it negates your loss.
Yeah.
It's like you never sold it, and so it can create all kinds of problems. And so maybe that security that you do want to buy goes up a bunch in that 31-day period. So that's always a risk. Not everybody wants to buy the back, whatever. But if you did, that's one of the risks as far as that goes, right?
Yeah, you could be buying back at a higher price than you sold out.
Yeah, if it's high enough price, it could negate the advantage of the write-off, theoretically. So, yeah, also you're kind of, you're lowering your overall cost basis.
Yeah, you're pushing off cost basis. So let's say you sell a stock and you buy it back basically at the same price. Your cost basis now is lower for whatever loss you had.
Right.
And so if you ever decide in the future that you need to sell it, you have more potential gains.
Yeah, exactly.
You can avoid that with step up. If you're in a certain situation and you're old enough, step up is always a key possibility, and so that's one
Yeah,
way.
so step up is when somebody dies that's one of the owners or the owner. Whoever's left as ownership or whoever the beneficiaries are, they get to step up the value of the cost basis to current price. So if I bought a stock at $1 and it's worth $10 and I inherit that stock, I can now set the cost basis at $10.
Yeah.
And I could theoretically turn around and sell it and avoid what would have been a $9 gain to the original owner.
Mhm.
So the problem with step up is somebody has to die. And if you're the one waiting for step up, well, you're not going to get it because, it could be a spouse or you can inherit it from, some other avenue. And step up's a really powerful way, but it is some portion of the consideration longer term. I can take these, losses and take these losses because I'm never going to sell the stuff, wait until pass away, and then my kids would get it with the step up, right?
And so you have to think about needs too.
Yeah, right.
Will I ever need this asset?
Right.
Is deferring the gains a good idea?
Right.
Also, you can think about, you're able to offset gains, but like, let's say you're in a zero, depending on your capital gains rate for the year. If you're on a low capital gains year,
Right.
maybe should you be offsetting this year?
Yeah, you can carry them forward, which is nice. But I think the step up is really kind of fascinating, right? I mean, just a little bit off topic, but I still, I wonder what the amount of trillions of dollars are sitting there waiting, right? We've seen it within our practice, right? People have these highly appreciated stocks. They don't want to sell them. Homes that aren't being sold. Between homes and highly appreciated stocks, I wonder how much is sitting there. And a lot of times it's an underperforming asset, and it's why you might want to sell it.
Yeah, a lot of times houses, especially with couples, is they're not sold until one partner passes away.
Right. Even if they need to. I mean, it's a really fascinating thing how much the step up can impact things. And you wonder if there'd be more velocity of movement of different things, housing and some of these stocks if you didn't have the step up. But anyway. All right, good. Well, that's our show for today. I apologize for the interruptions. We haven't had that before. We've had technical problems.
Yeah.
That's happened several times. Never had to pause it because we couldn't speak. Nonetheless, again, we won't be here next Friday, but we will be here the Friday after that. So looking forward to being able to see you then. And again, send in your questions now. We can start working on those. You can email them to us. We'd be happy to look at that. And then obviously, subscribe to the channel. You hit the little bell button if you want to get notified of new things. And if you want to talk to Ethan and I, go to our website, hit the book appointment button, and we'll set up a 30-minute time with you to chat about whatever it is that you're thinking about. So I want to thank everybody so much for coming today, and look forward to seeing you in a couple of weeks. Yeah, I've actually can't see it.